Good morning, everyone.
Good morning.
Good morning.
Thank you for coming to our special seminar on making special gifts directly from IRA and Roth IRA accounts to your favorite charitable organization. A lot has changed since we were here last, just a couple of months ago. We have a new law on the books that was passed in the 11th hour of 2012, and it's called the American Taxpayer Relief Act of 2012. What's interesting about this particular law is when we think about American taxpayer relief, let's think about that a little bit. It is not relief for taxpayers who no longer have the 2% payroll tax holiday. It is not relief for taxpayers whose top marginal tax bracket is 39.6%. It is not relief for those taxpayers whose long-term capital gains and qualified dividends will be taxed at 20% rather than 15%. It is not relief for those taxpayers who have itemized their deductions, which will be reduced under the P's provision. So why is it called the American Taxpayer Relief Act of 2012? Well, Americans do feel that there is a great deal of relief from going over the fiscal cliff. That's been avoided. And also, it is relief for the middle-class taxpayers whose rates have not increased. And surely relief for hedge fund people whose carried interest continues to be taxed at capital gains rates of 15% rather than 20%. So it's kind of an interesting law. It is relief for a lot of us, and it's not relief for some people. So we thought that would be nice, sort of a backdrop to start this morning's discussion, which is really focused on gifts from IRA accounts, individual retirement accounts, and Roth IRA accounts. So let's move right into this, and quickly, a little bit of history. The provision for gifts from IRA accounts began in 2006, and it covered the years 2006 and 2007 under the Pension Protection Act of 2006. It was extended for 2008 and 2009. Then the Tax Relief and Unemployment Insurance Reauthorization and Job Creation Act of 2010 covered the years 2010 and 2011. At the end of 2011, the law sunsetted. And so for 2012, there was no possibility to make gifts directly from IRA accounts and Roth IRA accounts. There were many opportunities, and many folks in Congress and lobbyists and so on tried to get an extension, tried to pass various legislation, but we all know that's been very difficult over the past several years. But now along comes this American Taxpayer Relief Act of 2012, and it in fact extends that law that expired on December 31st, 2011. It extends it and covers the year 2012 retroactively, and it covers the entire year for 2013. It's one of the extender provisions of this new law, and of course we who are steeped in philanthropy and donors and charitable giving are thrilled that this has been extended, even though from a practical standpoint it really covers the year 2013. So let's look into that on the next slide and see why it has some coverage for 2012, and how does that work? Okay, for 2012, there's a very, very limited window opportunity. It actually only covers the month of January 2013. And there's two aspects of this. A donor can make a direct IRA distribution to a qualified charitable organization, like Fleet Landing, up through January 31st, 2013. And they can have that distribution count for 2012, as if it were made in 2012. The Secretary of Treasury, since this law is so new, has not established the rules and regulations of how that donor actually makes that election to have it count in 2012. But it's hoped that that election process will be defined for everybody by April 15th of 2013. So that's one option. Someone can make that distribution up until January 31st and have it counted for 2012. Well, today is January 28th, so we basically have the 28th, the 29th, the 30th, and probably you should leave the 31st to make sure it's done. You really have 3+ days in which to even think about doing that. As far as we know, no one at Fleet Landing has taken that option, as far as we know at this particular moment. The second option, small window of opportunity, a donor who can convert a December 2012 minimum required distribution that they actually took in December of 2012. They can claim it as a charitable distribution gift for 2012. Because remember, in December of 2012, nobody realized, nobody knew that this law was going to pass, that this extension was going to exist. So they might have just taken their required minimum distribution anyway. But the law does allow folks to elect to take some of that required minimum distribution and apply it to 2012. And then they could do the same thing for the entire year of 2013. So really, for a limited window from January 1st to January 31st, it allows people to do something with their IRAs and Roth IRAs and have them count for 2012. That's an interesting part of the extension. But this slide and all the information on this slide basically expires 4 days from now, if someone hasn't done that already. Yes?
I want to make sure I'm correct on this, and I think I am, but you're saying that they can make it and it either counts as an IRA or they can make it and it counts as a charitable deduction, but not both.
They could if they have taken the required minimum distribution and they pay the income tax on that, then ultimately that is their money. Because that required minimum distribution is taxable. Okay. Then if they want to turn around and just make a gift of that, it would be no different than writing a check from a checkbook in any account that they might have. But they do have this limited opportunity that they can turn around and say, I'd like to elect that gift to be a 2012 distribution from my IRA account to Fleet Landing, for example.
But then it doesn't count as a charitable deduction.
It doesn't count as a charitable deduction, but they also pay no income tax on that when they do that. So the two will wash each other out. But again, it's a limited, very limited opportunity. We're down to 3.5 days to be able, basically, to be able to do that. So that's really the fundamental change so far as 2012 is concerned. So 3 days from now, we're into 2013, and so we thought it's appropriate to review what the opportunity is for 2013. So, what these acts allow for is an individual can make direct distributions from his or her IRA or Roth IRA to qualified charitable institutions and private operating foundations. That's basically what this law covers. And what we thought we would do, because we think it makes it easier for folks to understand, is sort of take a question and answer approach. What are the key considerations and what are the answers to those key considerations that an individual would have to think about?
Excuse me.
Yes.
In 2013, if you take the RMD, MRD, whatever, and give it to charity directly, okay, the donor does not pay tax, but he cannot claim it as a charitable deduction.
The donor, if he takes it as a required minimum distribution?
In December.
No, in
No,
2013.
Right.
She's asking
Oh,
about 2013.
Okay.
If a donor takes the required minimum distribution, in other words, the money has come to the donor, that is taxable income.
Okay, but can he, in planning to what he wants to do on 2013, say, I'm going to take my 2013 MRD and give it to Fleet Landing?
No. Can't do that and get the advantage of this.
I don't mean comes to me, I mean I'm going to direct.
Directly, yes.
That's what I mean, a direct transfer.
Direct transfer, yes.
Okay, so a direct transfer of my RMD
Yep.
in 2013 to Fleet Landing means the donor does not pay taxes,
Does not pay income tax.
that's right,
On
on
that.
that money.
Right. And does not get a charitable deduction for that money either.
Right,
So the two wash each other out
right.
for 2000.
But it's up to 100,000. It's not just the
Yeah, and
RMD.
we're going to go over that.
Okay.
Yeah, excuse me.
Those pieces of it. So, number one, who's qualified to even make these gifts? Haha, you have to be age 70 and a half or older. And you have to have IRA or Roth IRA accounts. You have to have both of those things to be able to even consider making these kinds of gifts. How much can I give? Qualified charitable distributions directly from these accounts to a charitable organization, up to $100,000 in the year 2013. That's pretty good. That's a big gift that can be done. So it's $100,000, and we say in any taxable year. We're really talking about 2013 because at the end of 2013, guess what? This law yet expires again. So if we go back to our history slide, maybe in 2014 we'll have another line on that history slide because it's been extended several times. Again, the law, as we said, it expires on December 31st, 2013. How are these qualified charitable distributions made? Okay, they must be made directly to the charitable organization by the IRA plan or the Roth plan administrator. Typically, it's a bank. It might be a trust officer, a trust account. Wherever that IRA is held, it must be made directly from there. Does not pass through the donor or the owner of the IRA. It passes directly to, in this case, Fleet Landing. It's got to be direct.
But in the case of the ones they took in December, and they already have the check, they can make the transfer.
In that window of opportunity, they can.
In
Yes.
4 more days.
That
okay.
one more, that tiny little window of opportunity. Can these qualified charitable distributions be made to fund charitable gift annuities, charitable remainder trusts, or pooled income funds? And the answer is flat out, no, they cannot. It's a real simple answer, N-O, no. They cannot be done that way. The IRS is really very smart and they're very clever. At the end of the day, they want their tax. And so the theory is, if you make this distribution and you pay no income tax, and now you use it to fund a charitable gift annuity, which is a no-no, slap on the hand for the charitable organization, you make that distribution directly and you get a charitable deduction. Now you have paid no income tax and you're getting a charitable deduction. And the IRS says, no, can't do that. There's rationale that they have. It's not unreasonable rationale. And if we look back, when we first created these IRA accounts, the last thing we thought about is this stuff. All we thought about is this was a way to put some money away on a tax-deferred basis. Tax-deferred. What the IRS means that that's deferred, but someday we want our tax. That's really what they're saying. Can these qualified charitable distributions be made to supporting organizations or donor-advised funds? Many Americans, for example, have donor-advised funds. The largest one in the country is Fidelity. It's in the billions of dollars. And no, you can't take this direct distribution from an IRA or Roth IRA and fund the investment or a gift into a donor-advised fund. Because a gift to a donor-advised fund is frankly no different than a gift to Fleet Landing. It's considered a charitable organization and you get a charitable deduction. So what they're saying is you can't avoid the income tax and then turn around and do something that gives you a charitable deduction. That's the rationale. It's pretty clear. Are gifts from 401k, 403b, or SEP accounts eligible? No, they are not. We're talking about IRA accounts and Roth IRA accounts. However, qualified transfers from these accounts to an IRA with a subsequent distribution from that IRA can be eligible. And that was true in the previous law, but it had some limitations.
Say that again, what is?
In other words, let's say you had a 401k plan.
Okay.
And in the previous law, you could make some transfers from that 401k to an IRA. You could roll monies over. And on a very limited basis, if you met certain qualifications, you then could use that IRA and distribute to a charitable organization. But it was limited. It has been expanded under this new law. And the expansion is this. Under and that should say 2013 2013, not 3012. But under this new law, it allows participants in a 401k plan with in-plan Roth conversion features to make transfers to a Roth account at any time, Congress made this change because the conversion is a taxable event when that conversion takes place. And so they'll get their revenue. And it will raise revenue for the United States government, for the Treasury. So they said, you know, we're going to make an exception. We're going to allow this to happen on not a limited basis, but a more widespread basis. We're going to make it easier for people to do. And once that conversion has been made to a Roth account, then that individual during 2013 can make a direct distribution to a charitable organization from that Roth account. So there's a limited opportunity there that has been expanded by this law. So it's a two-step process. You can go from 401k to Roth account, and then Roth account to charitable organization.
But you cannot go from 401k to charitable directly.
You can't go directly. But there's a way Congress has allowed in this new extension law. They said, you know, you could do that before on a limited basis. There were some rules about that. But now they've expanded that because they said when you make that conversion, it's a taxable event from the 401k to the Roth. So Treasury gets some income.
Okay.
Now, once you've done that, then step two, you could make that direct transfer to a charitable organization. So there's a little bit of a change there. Can these qualified charitable distributions be counted towards the minimum required distribution? The answer is yes, they can. That's fairly straightforward. What about taxes? Can I take a charitable deduction on my charitable distribution from my Roth or my IRA account? No, you cannot. You don't pay the income tax, but you also don't get a charitable deduction. So do I have to pay income tax on my charitable distribution? No. Such distributions were income taxable. They are now excluded from gross income. So now you don't have to pay a tax on that. So if you have let's say a very large IRA account, and you decide to give up to, let's say you wanted to give $50,000 to Fleet Landing from your IRA account, you don't have to pay any income tax. It's excludable from your income for the year 2013. That's nice. But you don't get a tax deduction on top of that. So the two kind of wash each other out. You don't get penalized in any way for that. Okay? The net effect is a wash. What if I don't itemize on my federal income tax returns? A lot of people don't. You can make a charitable distribution from your IRA account, and you can exclude that amount from your reportable income, even if you don't itemize. You still have to file a tax return if you don't itemize, but this will reduce your reportable income. So the itemization really doesn't have anything to do with it. It just reduces your amount of income, which would have otherwise been taxable that year. So that's some advantage there. What about state taxes? This is an interesting question, and one that we, unless we were tax attorneys in doing business in every state, all 50 states of the United States, we might know the answer to that, but we don't. There are certain states that may not exclude gift distributions to qualified charities for state income tax purposes. And that would be one of those questions where we would say to anyone, be sure and check with your advisors to make sure that you're not getting some other kind of a tax liability as a result of this transaction. And it varies from state to state. I honestly don't know what specifically the rules are in the state of Florida, for example, for that event happening.
Florida doesn't have state income tax.
Doesn't have state income tax, so like New Hampshire wouldn't be a problem.
But if we had a resident here who still claimed residency in another state but was living here, it could affect them.
It could affect them. And we would say, as we always do, be sure and check with your tax advisors to make sure you don't run into some state taxable event or suddenly be surprised that you had this event when you perhaps were under the impression that you didn't. Because we're really talking about the federal rules and regulations in this regard. Okay. So why are these IRA gifts attractive? There's some good reasons why they're attractive. The balance distributed to a non-spouse from an IRA account after the participant's birth certificate has expired, an expression we love to use around here, will be subject to income, and in many cases, estate taxes. This double taxation could consume upwards to 50% of the original value of that IRA account. So the IRA account as an asset may be an attractive asset to use in your gifting plans, because it doesn't die when the individual dies. It typically is going to move from somebody in somebody's estate. It's an asset that's owned. It would move based upon someone's estate plan to an heir, and it does not lose its taxability as a result of that. So that's an important consideration. Also, gift distributions from IRA accounts can be used to satisfy capital campaign pledges. Ha-ha! Olivia comes along and says, I have a pledge that I made to build Nancy's house. And I have 2 years to go on that, and I have this IRA account. Can I use those distributions to satisfy part or all of my pledge payments? And the answer is yes, you can. So all of a sudden, Olivia has discovered that one particular asset that she has, her IRA account, may be an attractive asset to use to pay down or pay off that pledge. So that's another idea. Gift distributions from IRA accounts may be attractive for donors who have reached their deductibility ceiling, but also want to make a gift in 2011, or in this case 2013. And there is a ceiling about how much one can give, and after that you don't get any more tax deduction advantage. So if someone has reached the deductibility ceiling and they want to continue to make charitable gifts, the IRA doesn't fit into that equation. Does that make sense?
Better tell me that again.
Okay. Under the tax laws, we can only give so much away every year.
Okay,
Once we reach that ceiling of what we can give away each year,
we're paying taxes on it.
then we don't get any more, we can't use those deductions.
50% of gross income, isn't it?
Right. So once we've reached that, and we still want to be generous, we say, hey, wait a minute, but I've got this IRA account, can I do something with that? The answer is yes, you can. Because remember, you're not getting a tax deduction for that. All you're doing is avoiding the income tax from that transaction. So you can go over and above your deductibility ceiling by using IRA accounts as a gifting vehicle.
Okay. That's still confusing, I think, because I thought you couldn't take an IRA and make a charitable deduction and get a charitable deduction.
You're not getting a charitable deduction for it, but let's say you've reached your 50%. This is for the sake of conversation. Say that the maximum, your maximum deduction based on your situation and circumstances is $50,000. And you've given away $50,000 and you've taken $50,000 worth of tax deductions. But you still want to be generous. You still want to support Nancy's house. And you say, hey, I have a capacity, I want to give more, but I don't get any advantage for giving any more. How can I do that? You can make that direct distribution from your IRA account. You're not affecting your deductibility limit, you've already used that up, the $50,000. And by giving the IRA, you're not going to create any tax deduction anyway because it's not allowed. But you are avoiding the income tax.
Okay.
So in that way, you actually could give, theoretically, and practically to Fleet Landing, you could give more than what your deductibility ceiling was in that year by using the IRA account as the asset to give.
Would that stand for a Roth too?
Yes, Roths and IRA, same thing. Yep, exactly. Gift distributions from an IRA account can make it possible for a donor then to make a much larger gift than a donor thought would be possible.
Yeah, yeah.
Because most of us really, without knowing this opportunity, wouldn't think of it necessarily. So what do I do with that? People will think about, well, I'll give some shares of Pepsi stock or IBM or this or that, or just write a check. And they don't really think about, well, what about that retirement account that I have?